Let's welcome on board Sunil Subramaniam as well. Sunil, hi, good afternoon. Good to have you on the show. A rebound, yes, today, but do you think it's only flattering to deceive, considering there aren't any conclusive negotiations, at least with China, when it comes to tariffs with the US?
So I would actually look at it differently. I think that yesterday's opening correction was overdone as far as India was concerned. Yes, the tariff implications were there for India too, but relatively we were always in a better position. Second, we are not an antagonistic country. We are not saying counter tariffs. We are actually negotiating a bilateral trade agreement. So when the market opened yesterday deeply down, I think the recovery has started from there. You see the second half of yesterday's market and today's continuity. And the reason for that is that increasingly it's being felt that India is not going to get harmed relative to others, number one. Number two, we have plenty of cash sitting on the DII books, whether it's insurance companies, asset management companies, portfolio managers, or the lot. And they are looking for price corrections to go and buy good quality stocks. Now, yes, the earnings season will give us the ultimate in terms of who is going to be a better outlook sector to do that. But given the depth of the correction at the start yesterday, it made a lot of counters for DIIs seem attractive. So I think as this buying process started midway yesterday and is continuing today. The second factor which is driving this as far as India is concerned is, of course, the RBI policy tomorrow and the strong expectations that there'll be at least a 25 basis points rate cut, definitely some liquidity infusion, and a small proportion of the market is hoping for a 50 bips if that comes. So that's why you see interest rate sensitive sectors are actually also going up today. So I think that to some extent, I would say that the impact on India, right, I think was overdone, and market is realizing that today we will face certain sectors, we will definitely face the heat of tariffs, but there'll be certain other wins too. So overall, on a balanced approach, and I think information is coming out from government officials that despite the tariff scenario, because of the weakening price of oil, right, I don't think our GDP projections are going to be way off the mark for 25-26 of the 6.5. Maybe a 6.4 to 6.6 range. So I think all of this means that India is not going to get unduly impacted badly. On the contrary, given the ongoing negotiations with America, maybe in 6 months' time, there could be a bilateral trade agreement dotted and signed, which means that we would be out of this whole tariff bracket. Because once you have a BTA, a bilateral trade agreement between us, then I don't think that the tariff scenario applies. So I think, yes, but doesn't mean that all sectors are going to gain and all of that. You've got to be still careful. But I would say that the depth of the correction yesterday is probably not going to get repeated. There will be volatile days when some bad news comes about the tariffs. There will be volatility, no doubt about that. But I think that there's enough firepower with domestic fund managers that quality stocks are going to get picked when they correct.
Today, you had the DII buy figure in excess of 12,000 crore rupees, believe it or not. But Sunil, what should be one's sectoral bias? And what are the sectors you would say completely avoid because of perhaps the global linkages?
So I would say this, if you do a Venn diagram, the overlap between a pure domestic story and a rate sensitive story. I think the two clear things are that a pure domestic story is less likely to get affected with all the tariff shenanigans that's going on. And the rate sensitive because I think the situation is now ideal because you have food inflation coming down, you have imported inflation from oil also trending down, and you have a threat of a global slowdown. So I think the situation is right for an RBI rate cut. So rate sensitives plus domestic. So then what do you pick? You pick BFSI, obviously, and you pick consumption, right? Right across from FMCG staples to consumer discretionary to auto to realty and durables. What you want to avoid? Well, I would still say wait and watch on IT. We'll still say wait and watch on sectors like defense, which ran up, corrected, but I don't know whether the correction is fully done. So rather wait and watch on those kind of fronts.
Right, wait and watch when it comes to IT and defenses. But yes, a positive outlook coming in for interest rate sensitives, given the fact that tomorrow you have the MPC meet outcome. 10 a.m. is when the RBI governor will be announcing the rate decision. What everyone is penciling in is a 25 basis point rate cut. But there is a section of market that's expecting a deeper rate cut at that. In fact, let me bring on board Gaurav to actually help us understand what are we penciling in when it comes to the MPC meet outcome.
Well, yes. Trump tariff is already causing turbulence in the market, but other than that, specifically in terms of India, we will be watching out on the RBI MPC meetings outcome, because now around 90% of the surveyed economists believe that around 25 basis point of rate cut is what we can see in this meeting as well. With this, RBI's the overall repo rate will go to around 6%, and there are two reasons why economists believe that. First is when we talk about inflation, now they believe that inflation is going to ease down. In fact, the inflation, which was as high as more than 6%, is expected to come as low as around 3.6%, which is the lowest in the last 5 years. Other than that, when we talk about IIP data, we are seeing some kind of slowdown because it is expected to grow at around 3.2% in the month of February. Other than that, what is key thing to watch out for is the RBI stance, because currently RBI holds neutral stance, but some economists believe that RBI will go ahead and change their stance to accommodative, while at the same time others believe that it will be really too early to go to and change the stance. And the reason being that it is currently at a trade war situation when we talk about tariff which are imposed by Mr. Trump, and that is the reason why they believe that RBI will still remain cautious. Other than that, any kind of commentary from RBI in terms of how the growth is going to be is a key thing to watch out for, because at this moment when we talk about India's growth rate, RBI believes that India can grow at a rate of around 6.7% in terms of GDP in FY26. So any kind of change in estimate is something to be watched out for, and any kind of changes in terms of the stance from RBI, and at the same time any kind of changes in terms of the commentary coming up from the global trades which are happening is a key thing to watch out for. But as of now, around 90% economists believe that we will see another rate cut in this meeting of MPC.
Our base case has been 6.5% for growth for fiscal 26, but we do see downsides of about 30 to 60 basis points to this number. The direct impact for India in terms of the trade exposure is lower when you look at it versus some of the other Asian economies. Inflation, I think, is sort of a good news for India and a silver lining. Inflation numbers have been better than expected in this year or the last three sort of odd readings that we've got. We do think March would also be below 4% and probably the next few months as well. Current number for fiscal 26 on inflation is at 4%, averaging with a good part of CY25 sort of remaining below the 4% mark, driven by easing food inflation. So I think inflation by itself does open up the room for RBI to react and respond. If they were not to do that, then real rates would expand. And then in this context of increasing external risks, of course, that has its own adverse impact on the growth trajectory.
Welcome back. You're watching Closing Trades right here on ET now. And if you look at the markets, we are hovering near the day's highest point. A very good recovery and steady recovery at that, given the fact that we've held on to the positive territory and only build on to that through the course of the day, with all the Nifty constituents right now in the positive territory, with Geofinance being the top gainer on the Nifty with gains of about 5%, followed by Shriram Finance as well as Adani Enterprises. And all the sectoral indices are in the positive territory as well. We have Shivangi Sarda also joining us on the show right now. Good afternoon, Shivangi. And I believe it is relatively been a very good afternoon. Over the last 3 trading sessions, all you could see was red on the screen.
Very good afternoon, Cheryl. So we see that the indices have been, witnessing fresh buying from the last 2 days. In fact, even after the gap down opening yesterday, we saw that there was a lot of strong buying that was seen from the lower levels. People have anticipated a good, drop in accumulating good stock. So overall, the texture of the market looks quite positive, and we are looking at buy on decline strategy as of now. Now, till the time Nifty manages to hold above 22,500 marks, then the next levels that we're looking at is 23,000 levels with a support of 22 marks. With, of course, buying seen in a lot of specific pockets like consumption, travel and tourism, some of the financial space stocks as well, which are resilient and strong even in these kind of market. Of course, India VIX has to cool off a little more for, further comfort to the bulls. So till the time it is above 18, some sort of volatile swings and cues will be witnessed in the market.
Okay, interesting. Shivangi, hi, afternoon. So what's your stock bias? Anything that's looking good for a long trade?
Hello, Aisha. So we've seen that, the travel and tourism pack is buzzing, and in that aviation stocks have been on my radar. The crude oil price drop has, been a good plus for Indigo. So this one's on my radar. Now, Indigo has been witnessing consistent buying from the last, 5 months, and any small declines have been utilized for buying. fresh breakout can be seen over here, and follow up is also quite strong in this one. So definitely this one's a good buy. Now I recommend a buy with a target of 5,400 levels and a stop of 5,070 zones. Next up on my radar is financial space stocks, and these have been doing quite well in such kind of a market scenario as well. So my pick would be on Bajaj Finance. We've seen that the negation of the last 9 trading sessions where it was little soft and making lower highs, lower bottom, but it has retraced right from its 50 daily exponential moving averages. And the long-term structure looks quite positive as well. And for the trading pick as well, there has been good amount of short covering along with fresh longs being added over here. So recommending a buy here with a target of 9,200 and a stop of 86.80 level.
All right, so those are some of the stocks that actually Shivangi is liking. In fact, Kunal, let me get your also picks then, your closing trade picks for our viewers.
So that will be Reliance Industries, something which I have been bullish on in the morning. Mentioned that the stock has come back into an oversold territory on the charts when it hit that 1150 odd mark, or slightly lower levels than that. And I think on the short term basis, the indicators RSI, MACD, etc. These indicators on the stock indicate that the stock is due for a decent bounce from current levels also. So would maintain that buy on Reliance Industries, expecting the stock to cross 1200 to 1220 mark over the very short term.
All right, so that's a closing pick coming in from Kunal, that is Reliance Industries. Sunil, let me come to you and get your view actually on the entire hospitality, the travel and tourism space, given the fact that now most of them will try and actually look inward, look at domestic oriented counters, and most of them actually cater to the Indian crowd, given the fact that you're seeing a rapid rise in tourism as well.
No, absolutely. And aviation and hotels and those which service that sector, right? The travel operators, all of them are looking very positive to me. Aviation especially, I think, because Shivangi mentioned this in terms of the oil crude price coming down. I think they are very high operating leverage, and with the kind of oil consumption that they have, it straight away goes into their bottom line. That's one. The second aspect is I think the Mahakumbh was probably a trigger to a lot of religious tourism happening around the domestic front. And I think a lot of temples are getting a makeover, going through their own, refurbishing and all of that, Ujjain temples and other temples. So I think that spark has picked up a lot. So domestic tourism should drive that kind of a flow. And I think hotels are also have built up a lot of capacity anticipatory to all of this. So I see those capacity utilizations running up. So I think these sectors, especially because they're operating leverage and they are sensitive to crude, I think that from that point of view, they are a good buys from a medium-term perspective.
IT, that's the one which is going to be in question, given that you've got TCS's numbers followed by Infosys, HCL Technologies, and then Coforge. Here's what the street is penciling in for an extremely oversold sector. Yes, you could debate about whether the valuations, even after the fall in some of these names, are looking okay or not. But one is anticipating that a recession in the current setup is going to be very different than 2008 or 2020 crisis. The average estimate, according to Kotak, is that about 22 to 38% is the kind of downside that we could see to the current face value on most of these names. And one is anticipating a 90 to 140 basis point cut in the FY 26 to 27 estimated EBITDA for the tier 1 IT companies. I don't know if we can bring up Kawaljeet Saluja's soundbite or not. He did chat with us earlier today, and he did say that what the current downside is something that the IT sector and the stocks have already priced in. Amidst the given scenario, he feels that TCS is best placed given its least exposure in terms of, amidst the IT services basket to US. So TCS is what he's betting on right now. Having said that, a recession, of course, he says, is going to be bad for IT across the board. In fact, let's hear out his bite.
If you are into a recession, then of course you have TCS that will hold up well amongst all these names. Let's say if you're looking at recovery, then you end up with Infosys. So if you have to basically make a split on the sector, there are two cuts that you can adopt. One is the percentage exposure to manufacturing plus retail as a bucket. And that will be the bucket which will be immediately the most impacted. And then you have to put in a cut of discretionary versus non-discretionary spending, or composition of revenues from discretionary versus non-discretionary. So if you take this particular cut, then TCS has the lowest exposure to manufacturing, a relatively high exposure to retail, moderate exposure to, let's say, discretionary. So that seems to be the best positioned. The companies that have a high exposure to manufacturing plus retail combination are Infosys, HCL Tech, Tech Mahindra, and LTI Mindtree, right? So they would be the most impacted. Now, if you basically delayer it further within this particular segment, Infosys has the highest discretionary exposure as such. So I think this is the framework, to adopt, which is manufacturing plus retail on one axis and discretionary versus non-discretionary. PITC, it's got a direct auto exposure, and auto is in the midst of the storm, so it's vulnerable from that vantage point. Persistent, yeah, actually, their portfolio in the current environment looks all right. Though, of course, the stock is expensive, so which is why we have a sell. So it may meet a lot of the criteria, but if it's expensive, then how do you make money, right? So we are cautious on both.
All right, so that's the take coming in on the IT space. Though Sunil did mention the fact that that would be a space that you would not want to watch out right now, or rather go all in right now and be a little bit cautious on that particular space. But Sunil, you did mention that you are liking interest rate sensitives, and in that, would you also like autos in particular, given the fact what is happening and the global exposure of some of these companies that they have, the auto space?
See, I would say that auto is a mixed bag. Yeah, auto components, because they're export oriented, definitely a challenge, right? In the high end auto, yes, maybe with Tesla coming in, if they're going to allow a lot of that, and if the tariffs on the US automakers are going to come down dramatically from us, then maybe yes, a little bit of a caution. But remember that the 1 lakh crore giveaway is going to come into discretionary, and auto is one of those which is bought on EMIs. And I think that at the lower end of the curve, see, we've been, all the time talking about a K-shaped recovery in the consumption, and auto is particularly where 7 lakh plus cars only have been selling. But I think this year we should see a broadening of that sale, and you would see entry-level cars also come in because of the tax break, because of the 12 lakh bracket. They are the probably ones who buy those. So I'm not so entirely, disheartened about auto. I think there's a good place to be there and to pick the right stocks. And ultimately, they are rate sensitive. So any rate cut by RBI with liquidity transmission would see EMIs coming down. So I would say that auto as a pack, you got to be very choosy. But I would not say that I'm negative on auto as a whole. But because it's rate sensitive, I would stay in that. But within rate sensitives, I would place realty a bit higher because it has come through a kind of a slowdown. But any kind of a EMI break and everything boost would help it, because it's a very cyclical, very high leverage sector. So falls are steep and rises also will be steep.
Right. Sunil, so good having you on the show today. Thanks as always for your time.